Hey, good afternoon, everybody. Chris Lester here, your weekly host. I want to welcome everybody and thank you for taking time out. Your weekly host. I want to welcome everybody and thank you for taking time out of your day to join us. We've been conducting these now, coming up on 7 months. So hopefully you're getting some value and able to attend the ones that you can. Once a month, one of the areas that I touch on is, sort of a recap of where the market has been and some of the forecasting tools that we have as to just sort of keep a pulse check on the economy. If any content that I cover you don't quite get or understand, feel free again to circle back with us or the advisor that invited you on the call, and we'll make sure to get you answers. So this market update, it says September 2020, but just to put things in context, the data is as of the last day of August. So we're always a month as a laggard as to what's going on. So you might go, well, the economy is sort of in a flux right now compared to the data, but this is a lagging content. So just keep that in the back of your mind. A little bit of a high-level overview as to where we're going to take this. We're going to first look at equities, and we're going to take a snapshot of the month of August and in general, how have these different indices done, equity indices. And then we'll take a zoom out a little bit and we'll look at year to date and how have these same indices performed in 2020, the latter part of 2019. That being said, once we're done with that, then we're going to go to one of our indicators called the bull bear S&P indicator, and we'll go over the annual view, and then we'll go to a bull bear indicator. And then lastly, we will switch over to a proprietary analytical tool, which is the Recession Probability analytics. So it just says, hey, based on some data, how are we looking as a whole as a country? So without further ado, we're going to get right into the growth markets for the month of August. And as you can see, pretty much everything has been doing well up and to the right. So in the last month, you'll see that actually the dark blue line is small caps, which are small size companies. Took off with a vengeance at the beginning of August. They were really on track to just tear it up. And then they sort of hit a lull and took a sideways pattern and to finish up the month up about 5.5%. But the S&P, which is a capitalized or weighted indice, actually took the day. And, we point that out that's U.S. markets, large cap. It's a price weighted index. And it's really right now what we're seeing is predominantly 5 of the top holdings are technological stocks. Companies like Facebook, Google, Microsoft, even you could go so far as to say Amazon. Apple obviously is in there. These are the majority of the holdings, and it's really carrying these large cap type stocks, which is really proven to be beneficial and I think holding up the economy. So again, further down the line, we have the dark blue line, which was small caps, finished up 5.5%. And then we have that green line, right? So that's developed countries, equities. And then we have that teal line, which is commodities. Commodities had a good month. Predominantly that indice is, although it's an index or an ETF that includes a lot of commodities, predominantly it's oil weighted. So it finally had a good month, and we'll compare that to an annual data here on the next slide. The pink is emerging markets. So this area has not fared well in the past, and it did have a pretty decent month. And I'll typically throw China in here, as well as say Brazil and some other countries that are looking to boost production. Towards the bottom, towards 0%, we have a black line, and then we have that teal color. So the black line is real estate, or REITs, and it finished up about 0.5%. And you can see it had a sidelong pattern, and we'll look compared to the year as a whole, where is real estate overall. But that sort of makes sense because we've had a little bit of an uptick in interest rates. So that's why you're seeing this sideways pattern. Now gold, which again took off with a tear, sort of did a little bit of a reversal, and you would say, oh, didn't have a great month. It's pretty much broke even. So for all intents and purposes, August was a good month for the economy as a whole. And I think a lot of people were coming off the summer doldrums and starting to look forward towards the fall and say, hey, where are things going? So as we look at the year-to-date chart, though, it's a pretty different picture. We'll see that gold has, as we talked about last month, has led the charge. And you have to understand that typically human nature is, if there's concerns of where the economy is going, you'll see that back in January, February, when COVID started to first rear its head, there's a flight to safety, and gold is considered that safe haven asset. And for the rest of the year, people have continued to flock towards this safe haven. However, you will see that off its highs in the last 2 months, it started to drift a little bit. And you'll see that this carries over to some of the longer term treasuries that we'll see on the fixed side. But then further, about halfway down, I'm sort of shocked to see this myself. If you had asked me in February and March, did I think that the S&P for the month of August would have been back to double digits? Absolutely not. That was the largest or quickest bear market ever in U.S. history. And to have the market down 30, 35% and come back within 6 months to be at double digits. Now, we've had volatilities the last couple of weeks, but I was pleasantly surprised. And a lot of that is probably due to the government intervention and stimulus and just, jobs numbers are improving. People are still unemployed, but I think a lot of people are surprised at the speed of the recovery. As we continue down, again, the pink line, that's that emerging market. Got beat up early, and it's gotten back to about even. And then you look at the small caps, and then the developed countries are down about 5%. So overall, compared to where we were, mid-March, end of March, I think this is just really good news. And then lastly, you start to see, hey, the housing and REITs are still down about 10%. And that makes sense, again, because interest rate environments have not been friendly, although there's been an uptick in home purchases of late. So just keep an eye on real estate. I had a client call today telling me that he was he lost his job and he's going to change careers and start to become a real estate investor. We had a long conversation about pros and cons of that. It makes no difference to me one way or the other, but I think a lot of people step into an area thinking that it's going to be the end-all be-all solution to their overall income needs. And real estate is a tough road to hoe, especially when you start to get older from an investment standpoint. And then lastly, you see that, that blue line, that light blue line is commodities, heavily weighted in oil. And it got its teeth kicked in because there was, just think about it. Again, it makes sense that a lot of the travel industry, the cruise industry, the airline industries, they were stockpiling oil. They were running out of places to store oil. So it's come off some of its lows, but it's still nowhere near where it was. And, it's probably no huge demand anytime soon. So that brings us to our bull bear indicator for the S&P 500. And if you've not seen this chart before, there's a lot going on here, but it's really not that complex. It's just a simple tool. It's an analytical tool that we use to basically, the first thing here and off to the right, this top line is your RSI or relative strength indicator. That's one indicator that is used, coupled with your moving average indicator, which is the one over here to the right is the second one down. That's the middle. And then the third is the MACD, moving average convergence divergence. And these are just indicators that are used by technical analytics that basically say, hey, look, if our observations over the S&P is if all three of these indicators turn negative, then it will trigger a red line. And you can see in 2000, this triggered. And then we had, we all know with the internet bubble burst that it went down until 2003, it started an upward trend. Here we had a head fake towards the end of 2006, 2007. It said it was going to go bad, but then it triggered and then it continued up. But then 2008 did happen. And again, the housing bubble burst and then it went green. And then we had an upward bull market. And then you can see towards the end of 2015, a little bit of a sideways pattern there. So by no means is it a perfect measuring stick, but it's just there to give us guidance as to what do we see on the horizon? Is there, are there any headwinds? Is there any cause for concern or pause? Right now, all three indicators since March have just turned over to green, which means that it looks like things should continue in an upward trend. So that's how we analyze it using this tool, and that's going to bring us now to the income market. This again is for the month of August, but the month as a whole, you'll see, has been pretty level for the month. The blue line there, 0%, is high yield corporate bonds. And basically high yield, when you hear that, that's another name for junk bonds. So it makes sense that, that people are taking a little bit more risk to try and get yield and have broken even here. And then we drop down to that teal, which is high yield munis. Again, just a little bit more risk. It's not far off of zero. So none of the bond market here in the month of August did tremendously bad. Rising interest rates, typically, if you have yield come in, if you're reaping reward, then your prices will go down. And if interest rates go up, then your yield will go down, and that's what's happened here. So now if we turn around and on this last teal blue line, that's the long-term Treasury bond market. And that got beat up in the month of August a little bit. And that's again because clear sailing signals have been given that the equities were looking a little bit more promising comparatively to some of the lower yielding portfolios. Now that being said, let's look at year to date. Treasuries are actually the winner here, very similarly to gold. You'll see that the top two are both the 20-year and the 10-year Treasuries. So because this is usually a flight to safety, that this means here that people are still uncertain, so they have some of their money going in. But if you look at the last 2 months, July and August, you'll start to see, at least in the 20-year longer term holdings, a little bit of a shift downward and to the right. But now when you go to the red line, which is your U.S. aggregate corporate bond, that red line just is saying, hey, the corporate bond market and faith in U.S. corporations is still strong. And then the next two, right, normal munis and also international bond markets. But the last one there is the high yield munis. Again, they got their teeth kicked in for March, and they're just now starting to recover. Because anytime you hear that word high yield, you start to think to yourself jump, and people tend to shy away from things where they're going to lose money. And that's what ended up happening in March. So, both the high yield munis and the high yield corporates are the laggards on this chart. So now to the bull bear indicator. Again, green lines, that means 3 positive triggers. And if we go all the way to the right here, you'll see that, since the end of 2019, we've been in an upward bull bond market. And with one little hiccup there, you see that little divot, that red line right here, shows that's March, where it had a lot of volatility in a very short period of time, only to finish slightly negative. And when a lot of the chaos was happening, the overall aggregate bond markets have held up and continue to seem to be in an upward trend as well. So we're watching this closely, the same 3 indicators. You have the RSI, moving average, and then the MACD, which is moving average, convergence, divergence. These 3 indicators give us an idea as to direction that we think that these sectors or these areas of the economy are going. Now, lastly, this is the proprietary analytical tool that was created, and this is taken in getting its arms around a lot of data. Everything from the gross domestic product to housing starts to money spent by the economy, and it's taken all this data and it's assigning a value between 1 and 100. If the number is below 50, then that's considered good news. The tool is called a Recession Probability analytical tool. And so the lower the number, the more positive the outlook of the economy. So it looks like right now that we had that spike, and in March as we were going over this, and in April and May, we had actually crossed over the 50 percentile, and we're in a recession probability seemed higher. But as of the last 2 or 3 months, it has now dropped 3 consecutive months back below the 50 percentile or the 50 number. So last month it was 46, and now it's down to 38, which is good news, which just means that based on purely a non-emotional standpoint, purely from a technical standpoint, when we look at some of the indicators, you could say by the end of August that even though March happened, we have, as a country, handled and navigated this tremendously well. Now, are there variables on the horizon? Absolutely. Do we have an election coming up? Absolutely. Is there the media on there trying to throw, and this is something I've always said, the media absolutely needs headlines and stories and bullet points. And so regardless of what it is, they will draw your attention to the S&P dropped 500 points, okay? But most folks are not entirely invested in just the S&P. And as we've seen, the S&P is a very small sliver of an overall picture of the entire economy, both of the US and of the globe. So, when you see the Dow or you see the S&P or you see the NASDAQ, those are very tiny slivers. And they're not necessarily true measurements of how the economy is doing. And that's where we talk about in the past, diversification and having strategies to be able to be and participate in the markets, but to limit risk and simultaneously gain upside potential. Right now, you can make the argument that the last 3 weeks, we've given back some of the gains, but I could also say that, hey, listen, we're still in positive territory for the S&P compared to where we were in March. And so we don't know what the future holds, but we don't want to be emotional. We've talked about this before in our decisions as we are in the market. We want to be in the market. We want to continue to be in the market. We want to invest simultaneously and over time in the market. And then if there is something that is going on in your life that needs attention, then we can take steps to make adjustments to make sure that they're suited for you. So guys, I hope you found this update beneficial. I'm a little nervous hopping on a plane on Sunday. I have to meet my partners going to Dallas. I have decided I'm going to wrap myself in saran wrap and wear ski goggles and have my mask on. So I'm going to do everything I can because, there is indication that we are experiencing a little bit of a second wave, but I have no choice but to get on a plane and get in a tube with other people and interact. So wish me a safe flight. I will see everybody next Thursday, and don't keep me a secret. Guys, have a great day. Thank you. And as always, if you need anything, give us a call. And make sure I have my disclosures here. I have to make sure that I click on those. And then also if the advisor that invited you on here, make sure that you thank them, and then if you have any questions, make sure that you circle back with them and they'll help you out as well. Guys, have a great day, and thanks again. Bye-bye.